Welcome to our webinar on economic outlook. Is now the right time to sell your agency? And this is the latest in our series of selling your businesses. And it's great to see so much interest in this morning's topic, hopefully reflecting the high level of interest. And for many of you who are regulars, continuing to find the content really useful. So for those of you who aren't so familiar with this, Kingston Smith is a top 10 firm of accountants, tax and corporate finance advisors. We work with businesses across a vast range of commercial sectors, including not-for-profit and private client as well. And in our West End office, we've got 8 partners and around 100 people specialising in working with media, marketing services, film, TV, theatre, anything that comes under that media marketing services bracket, or on naturally with a bit of tech, media tech thrown in there as well. And then we have a media specialist corporate finance team, and they specialise in M&A, particularly sell-side advisory, taking sellers through the entire sales process. They do a lot of strategic growth services, helping businesses to get into shape in the run-up to a sale, and a lot of financial due diligence as well, acting for buyers and private equity groups. 2022 was a record year for Kingston Smith's media corporate finance team, and we did 19 deals. Highlights of that was the sale of 23 Reds, Capgemini, and also the investment by Coniston Capital into CRC. We're also part of More Global, which is an international network. We've got presence in over 100 countries, so very well placed to help clients with their international growth aspirations and also their international M&A as well. So today, we're going to be looking at the impact that the current economy has had and is still continues to have on the M&A market. And we're going to hear the latest forecasts for the economy and then discuss what we're hearing from acquirers, investors and agency owners, as well as what we're seeing on particular transactions that we're involved in. So I'm delighted to be joined by Rhys Herbert. He's Senior Economist at Lloyds Bank, and also David Andrews at LDC, who'll be joining my colleagues from Kingston Smith, Paul Winterflood, who is Head of Media M&A, and Mel Reid, who is an M&A tax partner. And I think it's going to be quite an insightful, jam-packed hour with their views and perspectives on what they're seeing at the minute. So before I hand over to Rhys to kick things off, just a couple of housekeeping points. The webinar is being recorded, so do share with any peers, colleagues or friends who are unable to make it. In an ideal world, we'd have a lively conversation and you'd all chime in with your questions, but please do put them in the Q&A function. It's much easier to keep track of them in the Q&A function. And lastly, there will be a short survey at the end, so please do fill that out. It's super useful in helping to shape future seminars. So firstly, delighted to have Rhys Herbert with us today, and he's going to give us the economic backdrop to start with. He is a senior economist, as I said, at Lloyds Bank, and he's responsible for analysing and forecasting trends in major economies. He joined Lloyds Bank back in 2011, and prior to this, he worked at the economic consultancy Oxford Economics, where he headed up its industry forecasting service. And he's also worked for the Office of National Statistics, Prudential Assurance Corporation, Credit Lyonnais Bank, and the National Institute of Economic and Social Research. So thank you very much. Over to you, Rhys.
Okay, yeah, thanks very much, Esther, and welcome everybody. What I'm going to do is just talk for a few minutes about, if we could move on to the next slide, please. I'll just talk for a few minutes about the economic outlook. And in particular, I'll focus on the potential outlook for inflation, economic growth, and interest rates. Next slide, please. I think the first thing to say is that we are living in extraordinarily uncertain times. What I've shown here is an index of economic uncertainty, which is basically based on newspaper searches globally about the number of times that the words uncertainty are used in conjunction with stories about the economic outlook. And you can see that ever since the Brexit vote, there seems to have been a step up in this economic uncertainty index, reflecting what has been, a series of economic shocks, and many of which have been global. And I think this, in some ways, is not particularly, but I think it is worth noting that it just means that, right now, the level of uncertainty about what is going on in the economy is particularly high, and we need to, take any sort of forecasts about the economy with a pinch of salt. But what can we say with confidence about what's going on in the economy? And let's first of all look at the inflation background. So next slide, please. What I've got here is a couple of charts that show what's been going on with inflation. And the chart on the left-hand side, first of all, shows the recent performance consumer price inflation, both in the UK, but also elsewhere as well. And you can see, first of all, in 2021 and certainly in 2022, there was a sharp rise in inflation, not only in the UK, but globally. We saw multi-year highs in consumer price inflation. Now, what that suggests is inflation was being driven by global factors. And you can see in the chart on the right-hand side where we've split down the sort of rise in UK inflation into some specific factors, food prices, energy prices, other goods prices, and service sector prices, what was going on the inflation side. And it was primarily these global factors that were sort of a result of both COVID and the uneven recovery from COVID, but then the Ukrainian-Russian situation that principally led to the rise in inflation. Now, the good news is that these factors are now going away. And as a result, we are seeing sharp falls in inflation. Again, you can see in the chart on the left-hand side that that's not only true with the UK, it's true globally as well. In fact, inflation in some countries, notably the US, has been going down more quickly than in the UK. But we are also seeing, better news on the UK side as well. We had the latest figures for UK inflation today, which showed numbers for October, and that showed a big fall in headline inflation to below 5%, which basically means that inflation now is less than half of its peak rate of late last year, and also a more moderate fall in core inflation as well. So inflation is on the way down, and we're expecting it to fall further. By year end, we think inflation could be close to 4%. And next year, we're expecting inflation to fall back to the target rate of 2 and 2.5%. So much better news on the inflation front. If we can move to the next slide, please. And as a result of that, the interest rate environment is changing. What we've seen over the last couple of years is really big rises in interest rates. Again, not only in the UK, but globally. I've shown on the chart here what's happened to interest rates in the UK, the Eurozone area, and the US. And you can see that, interest rates have moved to their highest levels, since 2008. Now, even if inflation hadn't gone up, we probably would have seen a modest rise in interest rates. But, central banks, the equivalent of the Bank of England, has, felt that in response to this big rise in interest rate, they had to react by raising interest rates. Now, the good news here is that interest rates have probably peaked, not only in the UK, but other economies as well. And, the talk in markets is now moving on to, how quickly will interest rates come down? Again, we suspect that they won't come down anywhere near as quickly as they went up. But, we do see the possibility of interest rate cuts next year in the UK and elsewhere. But that will depend, of course, on whether inflation continues to come under control. And I just want to talk, about a couple of risks on the inflation side before I talk about the growth outlook. So next slide, please. Now, I would point to two upside risks on the inflation side. The first one is potentially oil prices. I kept going on about the number of, economic shocks we've seen globally. And of course, the latest shock is this new Middle Eastern crisis. In response to that, we initially saw a rise in oil prices, but because so far, at least, the Middle East crisis has been relatively contained, the oil price has fallen back after an initial spike higher. Now, that's clearly good news from an economics point of view, but I think there's still a risk that if the Middle East crisis sort of spreads more widely, we could see a further and significant rise in oil prices, which would raise upside risk for inflation. So that's the first potential global upside risk. But I think the bigger upside risk is a domestic one. When I talked about the reasons for UK inflation going up, I initially talked about it being a result of international factors, and I think that's true. But what we did see last year as well is a sort of rise in domestic inflationary pressures in the service sector, reflecting the tightness of the labour market and the fact that wages were rising quite sharply. And you can see in the chart on the right-hand side here, just how quickly wage growth is rising right now. It's around about 8%. Year on year. The latest numbers did show a modest fall in UK inflation, in UK wage growth, and there definitely does seem to be now evidence of the UK labour market rolling over and becoming less tight. But I think this still represents an upside risk. Lots of employers are still telling us that they are having difficulty recruiting or retaining staff. And as a result, they're having to pay up, in terms of wage increases. So, this is definitely a factor that needs to be watched in terms of whether inflation can come under control. So that's on the inflation front. Now, first of all, what's happening on the growth front? Next slide, please. Now, for much of this year, economic growth has been somewhat stronger than expected, both in the UK and globally. At the start of this year, there was lots of talk about the UK economy being in recession this year, and there was talk about output falling by 1%. Now, so far, that hasn't happened. In fact, it looks like the UK will have grown modestly this year. But there are now definite signs of economic activity rolling over in both the UK and the US. I've put a couple of indicators up here that first of all show that after a good start to the year, both UK activity indicators and also in activity indicators elsewhere have turned down. And also it's notable that an initial downturn in the UK manufacturing sector now seems to be spreading more widely, and the UK service sector is coming under pressure as well. Next slide, please. And I think one thing that in particular we would note is that we probably haven't seen the full impact of the past rises in interest rates in the UK as yet. And one factor that we need to bear in mind is the change in way that the mortgage market impacts on the economy. In the past, most mortgage rates were variable rates. So that meant that as soon as the Bank of England raised interest rates, the mortgage rate that people would be paying immediately changed. Now, of course, the mortgage rate market is mainly fixed rate. Around about 80% of the mortgage is fixed rate mortgages. But, they're fixed rate mortgages are relatively short duration. That means that that households at some time or other have to refinance their mortgages, and the likelihood is that many will have refinanced this year, or will have to refinance by the end of the year, early next year, and will have financed at higher interest rates. So this is a potential hit still to come through to the economy, and I think reinforces our concerns about near-term downside risks for the economy. Next slide, please. So what is likely to happen on the growth front? Well, we are still hopeful that the UK economy can avoid a recession, but it's going to be a close run thing. What we are going to probably see in the winter and through the spring is pretty stagnant growth in the UK economy, and indeed in the global economy, as a whole. Things could get better by the spring of next year, but the near-term risks are on the downside for economic growth. Now, what does this mean for interest rates? Well, as I said earlier, we think interest rates have clearly peaked in the UK economy, but there's a lot of uncertainty about how quickly they're going to come down, and that's reflected in financial markets. Of late, there's been a lot of volatility in bond markets, And you can see that reflected in this slide. Interest rates have gone up, market interest rates have gone up quite sharply. And over the last few weeks, they've fluctuated very sharply as market participants weigh up the likelihood of rates coming down and how quickly are they coming down. Over the last 2 weeks, there has been some growing optimism of that UK interest rates could start to come down by the middle of this year, the middle of next year, or possibly even sooner. And if you look at the market response to today's news on inflation, markets are now talking about the serious possibility that interest rates could come down as early as May of next year. I would say that our official forecast actually was that interest rates wouldn't start to fall until right the end of next year. But I think recent news on inflation has been somewhat better than we expected. So I think that does point to a risk of interest rates falling a little bit sooner than we expect. But don't expect interest rates to come down as quickly as they went up. We will see modest cuts in interest rates, but I think the Bank of England will be relatively cautious about how quickly they cut interest rates. Next slide, please. So just to sum up where we are, we've obviously gone through a very difficult period for inflation, but we now do seem to be coming out at the other end of it. Inflation in the latest numbers has come down quite sharply, and it's likely to come down further. And by the middle of next year, we'll be much closer to the growth target. That's good news on the interest rate side. There are near-term downside risks for economic growth. We are hopeful that we can still avoid a genuine recession, but certainly over the next 6 months, the growth outlook looks precarious. On the interest rate side, I think we have got better news ahead. It does look like now that UK interest rates have peaked and that they will start to come down next year. I think the Bank of England will be cautious about cutting rates, but given the sort of better interest rate environment, they probably will have some rate cuts next year. And I think the risks are increasing that those interest rate cuts could happen earlier than in the year than was previously expected, and actually could even start before the middle of next year. And but perhaps I'll leave it there now and turn things back to Esther.
Lovely, thank you very much, Rhys. I think there was enough good news in there for us to be feeling a bit positive about things to come. But yeah, a shame for many that interest rates aren't going to come down quite as quickly as they went up. So next up, we've got Paul Winterflood, who I said is head of media M&A at Moore Kingston Smith. Paul's going to be providing the latest M&A market update, covering the latest deal activity. And do watch out also for our full M&A quarterly report, which should land in your inboxes shortly after this webinar. And that will go into much fuller detail around the key subsectors of interest for investors and notable deals from Q3. So over to you, Paul.
Thanks, Esther, and thanks, Rhys, as well. That was really insightful. So I'm going to, as Esther mentioned, I'm going to do a view of the M&A market, look through some of the trends and notable transactions over the past few quarters, as well as do an outlook on the period ahead. So just quickly, for those of you who haven't joined before, just to talk through the basis of our analysis. So we track all the deals in the media space in the UK, which involve either a UK buyer or a UK seller, and that forms the basis of our ongoing analysis, as well as our quarterly reports and webinars such as this. If we roll back 12 months ago, we were in a very hot market. It had been the case post-COVID, and as you can see from the left-hand side of the chart, that sort of deal activity ramped up by quite quickly. I think one of the points that really resonated with me from Rhys's comments was about the sort of perma crisis that's been in place since 2016. I think we've been doing our sort of quarterly reports since then, and pretty much every quarter we've been talking about, well, if only there can be a bit more certainty in the next quarter. But despite all that, the M&A market has been pretty healthy in the media space. If we roll back 12 months, we're certainly starting to see some macroeconomic headwinds. The tech sector was slowing down. It was even worse in the UK thanks to Liz Truss's budget, and so we were seeing the cost of money going up. Anecdotally, we were seeing buyers put investment plans into the UK on hold, and then we were and then at the start of 2023, things like the actors' strike and reduced ad spend were hardly helping the market. So us and the broader deal community were quite nervous about 2023. The first half of the year was a lot better than expected, volume wise, and actually 96 deals is still still a pretty good level of activity, and particularly those deals we're seeing in the lower mid market. So those are deals under 50 million pounds. So for a lot of independent businesses and independent agencies, there's definitely is activity there, but the market is definitely tough. There is also a bit of a lag on deals in terms of the length of time it takes for deals to be agreed and then to show to progress to completion, and probably the average amount of time is probably 3 to 6 months. So I unfortunately would anticipate there to be a further drop in the activity in the numbers anyway in quarter four. But I think off the back of Rhys's outlook, I think that aligns with some of our expectations that the second half of next year in particular we should see things picking up. The second line on the chart is the percentage of deals that have private equity involvement, and that's been at a pretty consistent level now, probably post COVID, and particularly I think since 2019 really, when private equity really started investing in the space. I think that the take home here is that the chances are you're going to be acquired by private equity either directly or indirectly, because they make up such a large amount of the buyer pool, and that's despite interest rates being high. When there's a higher interest rate environment, it's more challenging to construct transactions, and particularly when there's a large amount of debt in deals. So it's still promising that there's such a that indicator has remained high, and deal activity is still relatively high compared to the long-term norms. And I'm sure David will have additional views, but certainly our view on the market is that the presence of private equity is certainly a good thing. They're professional deal doers. As long as the target is trading well, there certainly will be the appetite for investment to continue. So this next chart just looks at some of the capabilities that are being acquired, and I'll just draw your attention to a couple here, just focused on the marketing services element within our analysis. And Hotspot has been, and this has been popular for quite a while, but e-commerce capabilities took top spot this quarter. Certainly those capabilities continue to be sought after post the COVID boom. They've been e-commerce has certainly been at the top of many acquirers' lists, and I think that's very much here to stay, as brands looking for ever more innovative solutions to deliver to their clients. Second place was advertising. I think that's been, which is I think is an excellent thing for the creative industries as a whole, and that again has been a trend of recent quarters. And despite the clamor for digital capabilities such as e-commerce, performance marketing, creative skills are always sought after and highly valued, which is pleasing to see that demand reflected in the M&A activity. And for those of you that are attending our annual survey event later in the month, the importance of creativity is going to be the focus of our panel discussion for that reason. Just looking at a few notable transactions that have happened in this quarter, and we're highlighting 4 here, and all of them are pretty significant deals. So first of all, we got Uncommon. They were acquired by Havas for a valuation of 120 million. Dentsu acquired Tag for $500 million. Brain Labs were invested in by Felperia's partners at a valuation of $320 million as well. So these are big transactions that have been completed. I think there's a few things to note here. Firstly, the 4 of those are network acquisitions. So the networks are acquiring again where there's quality they're looking to acquire. Secondly, it shows that quality sells at high prices, regardless of the macroeconomic backdrop. And lastly, the Brain Labs Falfurrias deal. We've mentioned previously, for those that joined these webinars before, that the concept of private equity secondaries. So that's where a private equity house will typically invest in a business. They'll come to the end of their investment cycle, and at the end of that cycle, typically they will either sell their business onto another private equity house, or they will sell that business typically to a trade buyer. When I mentioned that a lot of private equity really started started investing in the sector in about 2018, 2019, and so based on a sort of a 3 to 5 year investment time horizon, there's a queue of businesses that are going to be going through that. Brain Labs was one. MSQ in quarter 2 was another one, and the fact that they've gone to another private equity house is in terms of the M&A market, is certainly a very positive thing in our view. It gives us comfort that the market is going to be strong over the medium term as these businesses, both Brain Labs and MSQ, were executing buy and build strategies. So the fragmented buyer pool we're seeing in the media M&A market is going to continue for the medium term. So just in summary, the market is down at the moment, yes, but I'd say that's more of a sell side problem. I think it's for businesses that are trading well, there's lots of well-funded acquirers out there looking for opportunities. There's been a perma crisis for the last since 2016, so acquirers are used to dealing with uncertainty and for transacting through uncertainty. So if you're a seller that's trading well, you've got an incentivized management team, a growing good value proposition, then actually, perversely, it could be quite a good time to sell, because acquirers are certainly seeing less transactions or less quality opportunities, but they still want to do deals. So that's probably the short-term outlook. And then the medium-term outlook is when the macroeconomic environment stabilizes, we're expecting to see a strong market returning. So that's the end of the M&A update. So back to you, Esther.
Thank you, Paul. Thank you very much. So now I'm delighted that Rhys and Paul will be joined by David Andrew and Mel Reid. So if we can all turn our cameras on now. Mel is an M&A tax partner at Moore Kingston Smith and works very closely with Paul and I across numerous M&A transactions in the media space. David Andrews is a partner at LDC and works very closely with management teams across London, helping them to realise their growth ambitions with the support of a private equity partner. And since joining LDC in 2011, he supported a number of the firm's high-profile partnerships, including Bliss, Headland, RightSpend, Crowd, FC Business Intelligence, Ocean Outdoor, Blue Rubicon, and 24. And he also continues to support businesses such as Blu-ray Travel and Igloo.com. He's a specialist in media, digital and the technology sectors, and he joined LDC from global consulting firm Monitor Deloitte. So I'm going to lightly chair a panel discussion. Like I said, it will be more lively if people can contribute questions, but please do pop them into the Q&A function, and then I will weave them into the questions as we go. So I think starting off with you, David, since you haven't had an opportunity to speak yet, how are your portfolio companies in the media sector sort of navigating this uncertain economic landscape at the moment?
Thanks, Esther. I think it's undeniable, and Rhys's update emphasises that like all sectors, macroeconomic headwinds are affecting our portfolio. We have about a dozen media-focused businesses in the LDC portfolio today, and it's not a secret that those portfolio will have lower growth rates at a top line level in 2023 than they were perhaps trending on before. The focus for LDC as an investor is that we fundamentally back management teams. So while, as you rightly introduced me, I'm a specialist in the media and digital sectors, I'm an investor first, and I'm by no means an expert. We look to partner with management teams who are the experts and have the capabilities to drive their businesses forward. So, fortunately, despite, macroeconomic difficulties, the overriding performance of our businesses is much more micro-driven. It's focused in on the adaptability and capabilities of the management teams that we partner with. So while growth rates will be lower in 2023, the majority of in fact, I think all of our media portfolio will be growing ahead of the market underlying growth rates, which is a fantastic position to be in. And that's down to, identifying opportunities even in difficult markets, wherever they may occur, and that adaptability of management. Now, a lot of our businesses, as Paul alluded to with private equity models, are on buy and build strategies anyway. Some have pivoted towards buy and build in 2023 to identify new growth opportunities, and we're very supportive of that. On the other side, a private equity partner such as LDC can allow management teams to be a little bit more flexible, in making investment decisions. So if the right thing to do this year has been to focus on operational improvements or open up new markets or invest in new products alongside considering M&A, that's strategies we can support, and back the management teams to deliver on, giving themselves opportunities to, drive growth even in a difficult market.
I mean, have you seen any sort of notable differences in how different sectors and capabilities have responded to the economy?
So as an investor, we're sector agnostic. Our portfolio, across the UK businesses broadly maps UK GDP. There will be differences across, kind of major sector groups. But again, I go back to the same theme of within all of that, it's a focus on management and identifying opportunities for growth. Within media, again, our portfolio is relatively broad, and I wouldn't say, from that you can draw out any particular trend. If there is one to draw on, I think the whole sector, and especially marketing services, is benefiting from, rapid digitalization. One from, the work that it can do, but also, the complexity that brings to clients in navigating the ecosystem in which they operate. So, businesses need to have a digital and technology story, not necessarily having an answer to AI but within that, automation and understanding where they are on their technology journey and how they'll take advantage of that in the medium term.
And that's giving them an advantage, you think?
Yeah, I think absolutely. Well, I think if you don't have that, you're at risk of, losing ground against your competitors who are being more forward thinking.
And Paul, is that reflective of the clients that you're working with?
I think definitely, yeah. I think the lower growth rates is certainly something that we're seeing across the portfolio. I think the points in the year where there hasn't been a uniform drop off in activity levels and a uniform point where everyone's been struggling. I think we've seen different people with different exposures to different sectors and verticals going through stickier points at different points in the year. I think particularly those that have a lot of tech clients, for instance. The first half of the year in particular, they found that pretty tough. Those involved in the in production and those linked to the actors' strike. I think who had exposure to the actors' strike, for instance, that had they found it difficult at a certain point. I think one thing that's sort of universal almost has been people have found new business a lot tougher, decisions being delayed. But having said that, we found that clients that are still growing have had a lot of success with account development in particular, which is a sort of great way to grow in a far better from a margin perspective than an expensive pitch process.
Yes, pitches in this sector are very, very expensive. So if you can avoid those, then that's a win-win on the margins. So Rhys, I mean, when do you think the economy will be on a more even keel? And I guess more importantly, how soon do you think that'll actually start feeding through to businesses? Because there's always a time lag in these things, isn't there?
Well, I think by the spring or the middle of next year, I think by then we should see things on a more even keel. As I've mentioned, we're expecting inflation to come down sharply further by then. But I think the important thing is not just that headline inflation comes down, but that, the Bank of England, clearly sees that these domestic inflationary pressures from the labour market are under control. I think by the middle of next year, it should be clearer whether or not that is the case. And we think it's most likely that it will be the case. Also by then, we should have seen the full effects of interest rates on the real economy by then. So hopefully by the middle of next year, we'll see a sort of a situation where as inflation stabilizing at much lower levels than we've seen over the last couple of years, and a situation where economic growth has been leveled off again. And obviously those are both positive factors. And, by then as well, we're expecting to see the start of interest rate cuts in the economy as well, which will act as a sort of further support to economic growth. So I think by the spring, or certainly the middle of next year, the economic environment will feel a lot more positive. But I'm not sure if it will do, over the next few months, over the winter months. I think we've still got some tough headwinds ahead in the next few months.
Yeah, no, I have no doubt. And Paul, how are you seeing that sort of expectations flowing through into the M&A market, into what sort of potential buyers and private equity houses are doing?
I think from the M&A market, as I mentioned, there's a lot of appetite generally is strong. There's funding in place for people to be able to do deals, and there's a fragmented buyer pool at the moment, which is certainly a very, very positive thing. The challenge is turbulence, and turbulence is affecting both buyers and sellers. What I mean by turbulence is like trading dropping off, clients being lost. That probably has more of an impact on the sell side because you're typically smaller. If you lose a client, it's likely to be a bigger proportion of your profitability. Or if you're growing at a slower rate, then that has more difficulty. That has valuation. That creates valuation challenges. So that's definitely inherent in the market at the moment. I think on the buy side, it's potentially I think private equity are looking to do deals, and they're they're not impacted in the same way as a trade buyer by that volatility. And I guess a way to illustrate that was I heard about a transaction a few weeks ago where it was close to getting completed, but the buyer ran into difficulties in trading in a different market, and so their investors asked them to redeploy their resource, and so the deal was put on hold effectively. On the sell side, it's probably more of the case that the impact is probably more the case that deals are sort of stretching. Buyers are taking a lot longer to just check that they get comfortable with the business, get comfortable with the trading. If people are sort of targeting a valuation level, then with growth rates being slower, then it may mean that at the point when the valuation works from a profitability perspective is a bit further down the line. And because deals are stretching, that just creates more likelihood that something could go wrong in that intervening period, which has a knock-on impact on completion rates. I think the final thing is potentially around valuations. So I think we're seeing a bit of a two-speed impact. So in a higher interest rate environment, particularly with deals that are backed by debt, when interest rates go up, the cost of doing a deal therefore increases. And so there's a natural downward pressure on valuations. Because acquirers are seeing less high quality opportunities are probably being more sought after by the same number of buyers, that there's a equal and opposite supply and demand impact. And so those valuations have held. It's probably the less sought after acquisitions where there's downward pressure on valuations, and acquirers are wanting to be more conservative to provide downside protection, that those valuations are the ones the less attractive and sought after assets that are where there is a definite downward pressure on valuations, and or if the business isn't trading that well, a big question mark as to whether the business is sellable in the first place.
Yeah, I mean, I've certainly got 2 clients at the minute where deals are on pause. One because the acquiree isn't doing, well, I think they've got some client spend that hasn't been committed to, so not forecasting as well as they thought, and another because the acquirer is having a bit of a rubbish time. So I think lots of different reasons. I mean, David, how's all that feeding through to your portfolio's M&A intentions in terms of, thinking about, financing and valuations?
Yeah, so I think I echo all of what Paul said there. As LDC, we're a little bit different to most other private equity houses. All of our funding comes from the balance sheet of our parent, Lloyds Banking Group. So that gives us a greater deal of flexibility in how we deploy. Paul earlier in his piece alluded to fund cycles dictating, activity on primary deals and for portfolio bolt-ons. Our support from Lloyds Bank means we don't have that fund cycle, so are much more willing to invest through the cycle. So that plays to both our own intentions to invest, which remain high, and media remains a core sector for us, and within our portfolio businesses to support their own M&A ambitions. So just to put some context around that, in 2021. We did 65 bolt-on acquisitions across the portfolio. We did 45 in 2022. Year to date this year, we've done 27. So our volumes are slightly down, but not materially down from a portfolio bolt-on point of view. In terms of new business activity, we are seeing the market slightly depressed. Paul, your stats were actually slightly more positive than what we track for our kind of core competitor set. We think volumes are nearly down 50% year on year, but in that context, LDC's still done 13 deals this year, which means we've probably increased our market share, which demonstrates our willingness to invest. That said, the deals we are doing are taking longer to generally, not always, but generally taking longer to complete, both within our portfolios for smaller bolt-ons and within our primary deals. That's a function of lots of the things Paul discussed, but needing in this economic environment to do the diligence, to be confident in your investment decision, just taking a little bit longer than it has traditionally.
And Mel, are you seeing any impact on deal structuring, and what are the key watch outs from an M&A tax perspective?
Thanks, Esther. I think sort of from an actual deal structuring perspective, it's probably business as usual in terms of, particularly in the private equity sector, we're still seeing highly leveraged deals are still obviously difficult to do with where interest rates are at the moment. I mean, I think there's it potentially makes it more difficult in terms of sort of any sweet equity incentive for management coming in, because, you know, with the interest rates being higher, you know, it might be harder to achieve the target growth rates for them. So I think incentivization of management through sweet and maybe through some other equity incentive pre-sale is, you know, even more important than ever. You know, in this sector, we've always sort of seen long tails in terms of earnouts or put and call options. You know, typically we would always, they might have been completed within 4 years, maybe 2 or 3 years ago. You know, they tend to be sort of stretching a little bit more, where it might be 4 or 5 years sort of earnout period. But I think, you know, overall from a structuring perspective, it's business as usual. But I think, sort of to echo David's comments, you know, you would look to invest in management teams, and, you know, in terms of key watch outs from a tax perspective on an M&A transaction, it's about getting the management incentives structure right, both from, you know, an investment perspective to make sure the right people have got the right level of incentivization, but also from a tax perspective, because I think, you know, what we see coming out of due diligence that does slow things down significantly are tax risks around shares and equity that have been given to management. And, you know, these are significant tax risk numbers that can come out of that. So I think probably, I guess if I was to give a piece of advice, it would be, you know, make sure your house is in order in that, because it really can, and we've seen it on some of the recent transactions that we've been looking at over the last 12 to 24 months. It can really be problematic in terms of deal structures.
Yeah. And what I mean, what other factors could influence the economy over the next 12 months, Rhys, and what could the impact of the general election bring us?
Well, obviously, one thing that could come out of left field is another global shock of some sort like that. You know, we've talked about a lot of this uncertainty being generated by, you know, stuff just happening internationally and not having a knock-on effect on the economy. You know, it appears that, you know, current events in the Middle East, while tragic, from many standpoints, from an economic point of view, are so far having, you know, only a small effect. But, you know, it's possible that we could see, you know, a sort of, you know, the impact of that escalate, or we could get another international shock, say something that incorporates China or something like that. So that's one risk. You know, domestically, I'm afraid there's, you know, there's risk on both sides. I talked about the labour market and the importance of that coming under control. If the labour market remains tight, you know, that points to upside risk to inflation. You know, against that, you know, if the economy proves less resilient when they thought, that implies downside risk. So, you know, there's definitely risks domestically to the economy as well. In terms of the impact of the general election, well, obviously we will have to have a general election by January 2025 at the latest. You know, so that means almost certainly we'll get a general election next year. Unless the opinion polls change dramatically, I would have thought the government will try and push it out as long as possible. So the election will probably not be till the autumn. But, you know, there could be knock-on impacts on the economy in the run-up to that. I'm really getting two broad questions about this. You know, first of all, how much difference will it make to policy in the run-up to the election? And, you know, what will happen after the election? I think the first important thing to bear in mind is that interest rates are set in the UK by the Bank of England, and they are sort of quasi-independent for the government. You know, the senior people get appointed by the government, but they're not impacted immediately by the electoral cycle or who's actually, you know, forming the government at that time. So the interest rate environment, you know, won't be immediately impacted by the general election, and I think that's important for the economy. But you know, the election and the government could have an impact in other ways, and one of the ways will obviously be fiscal policy. I think there is a reasonable chance that in the run-up to the election we will get some sort of tax cuts. Next week we will get the autumn statement, and the Chancellor may talk about that, but he may well wait until the spring before he talks about that. There's only limited room for tax cuts, but we could get some small tax cuts, possibly just things like inheritance tax and stamp duty. But I would have thought, in order to make a sort of electoral splash, they might want to look at other things like income tax or whatever like that. Looking at the sort of the position after the election, though, any government is going to be sort of quite constrained. They are going to inherit an economic environment while potentially getting better, is still one of low growth, and also one in which the government debt situation and government deficits will be very high. So against that background, it's going to be very difficult for governments to make major changes in policies. There's big questions ahead about, how do you cope with the NHS, and, how do you cope with an aging population? What do you do about low productivity growth in the UK? So there's big questions for a government going forward. But in terms of what they're actually going to be able to do immediately, they are going to be very heavily constrained, whoever forms the next government.
Lovely. Thank you so much, Rhys. So I'm a little bit of my battery's about to go, and I'm currently being rescued by somebody who's trying to plug me in. So hopefully I'll hold out before we go. So Mel, I mean, what are the possible impacts that a general election could have on the tax environment, and also in a weakened M&A environment, what other options do entrepreneurs have?
Thanks, Esther. So, I mean, I think, if we're talking about a change of government, then, Keir Starmer and the Labour Party have effectively come out and said that funds, they're intending to change how fund managers are taxed. Currently they benefit, so thinking about the private equity market investors, they benefit from capital gains tax rates on their sort of payout from their investments. And certainly Labour are expecting, they've said they'll change that to income tax rates. So I think, what impact will that have on the M&A market? There may be some fund managers, particularly in, UK fund managers, looking to exit some of their funds pre any general election, which might actually be positive for the M&A market in the short term, in terms of, actual M&A activity going on there. I think, we'll have to wait and see, what that means for the long term. There's always talk about capital gains tax rate increases, and whether the sort of what was called entrepreneurs relief, the £1 million limit, will be reduced. I mean, I think it's already come down from 10 million, so it's not a particularly generous tax relief anymore. And certainly, Keir Starmer again has acknowledged that the need for entrepreneurs and business investors to have certain tax relief supporting the economy. So I think, we'll it's crystal ball gazing, isn't it? We'll wait and see. And of course, as Rhys alluded, we've got the autumn statement on Wednesday. In terms of sort of a potentially weakened M&A environment, undoubtedly there's still investor pools out there in the sort of private equity market. But, for those businesses that for whatever reason they might not think private equity is right for them, we are seeing still in that employee ownership trusts, so EOTs, are a popular alternative. And for those that aren't familiar with EOTs, it can effectively allow business owners to exit with a 0% tax rate. So obviously the tax is very attractive. It's a very friendly sale because you're effectively selling to your employees on deferred terms, and generally we're seeing that's a much more friendly way, I guess, rather, and in a way to create a sort of market for the sale of your business in a weakened environment. More and more we're seeing those backed by banks and so that money can be paid out more initially. But that is definitely, certainly in this sector where it's a people-led business, we're seeing that's a popular alternative.
Thanks, Mel. And actually, Paul, somebody did ask a question earlier as to whether EOT transactions were included in your deal summary. I don't think they are they? No.
No, they're not included. No.
Yeah. Sure. So we have got 3 minutes left. So I think we'll have a quick sort of round robin. What are your views on the outlook for the years ahead, and what should people who are considering selling be doing or thinking about? So David, over to you first.
Yeah, just very quickly. I'm an optimist. I think, and with the backing of LDC, we will continue to look to invest in media assets. If I was going to give advice, first and foremost, it's performance of the business. Focus on delivering high quality service to your clients. And driving what growth you can in a difficult market will always serve well. But when it comes to prepping for a potential transaction, don't underestimate the need to have your ducks in a row, have good financial information and data within the business, because whether it's a trade or private equity buyer, having good quality information that tells the story of your growth within the context of your market and gives an investor or buyer confidence in the outlook over the medium term is always money well spent.
Paul? Oh, you're on mute.
Oh, sorry. Yeah, very similar note to David. Get your house in order, get sale ready, incentivize your management team, work on your value proposition, get your data sorted. Great businesses will be acquired regardless of the macro backdrop, and in the medium term, we're bullish about the M&A market.
Not a short list of things to do then. And I think caveat that we start thinking about that way before you're planning on selling. Really don't leave it all to the last minute. And Mel?
I think Paul's probably stolen some of the things I was going to say, but echoing what you've just mentioned, Esther, thinking about incentivizing your management team, because any buyer will always want to make sure that they are incentivized and make sure it's done as tax efficiently as possible. So we quite often see people come to us 2, 3, 4 months before wanting to go to market, and it's much better trying to actually sit back and get a plan together now as to what the future looks like for management.
Absolutely. And then finally, we'll end with a bit of crystal ball gazing. So Rhys, where do you think interest rates are going to settle?
Well, our guess would be somewhere around about 3 to 4%. We think is a sort of a reasonable estimate of what the equilibrium rate would be. So not as low as we saw them in the pre-COVID era, not as high as current levels, but somewhat in between. And I would have thought that people need to get used to interest rates about at those levels. That's still a low level compared with much of post-Second War UK history, but obviously it's not as low as of what we've on average we've seen over the last decade or so.
Perfect. Thank you very much. Well, we are at that witching hour. Like I say, it's being recorded, so please do share. Please do fill out the survey. It helps us to shape future seminars. A very quick plug: we have got a seminar, a real life in-person seminar at BAFTA coming up on Wednesday the 29th of November. It's in the evening, sort of 5:30 Jobby, where Paul will be presenting the results of our marketing services KPI survey that we perform every year and have done for the last 30 odd years, and that will be followed by a really interesting panel discussion with Camilla from Elvis, Sarah from the And Partners, and Natalie from Uncommon. So please do look out for emails and posts on LinkedIn about attending that, because the more the merrier. So thank you all very much for joining us, and thank you very much to our panelists. It's been incredibly insightful and jam-packed hour, and I hope everyone has found it really useful. I have certainly found it useful myself.